All right. Hey, everyone. Welcome to another episode of Pitch Deck Insights brought to you by Visor. I'm your host, Litan Yahav, and with me are the mega investors, Mike Arndorfer and Hans Box. And before diving in, I wanted to give a little background about Mike and Hans. So Mike's the founder of a company called A2 Passive Coaching. That's where he helps LPs and GPs become better operators and better investors. Now, Hans is the co-founder of Box Wilson Equity Group, where they focus on cash flow and value-add private investments across a ton of different asset classes: multifamily, self-storage, mobile home parks, distressed debt, office, pref equity, everything you can think of. But besides of both of these like day jobs, all of us have been passively investing for a while in more than 120 private investments. And so that basically is the background for us to have the credibility to actually do this show. Now, if you're interested in learning more about Mike and Hans, you can check out their contact info in the show notes below. I'm sure they'd love to chat. Now, diving into this episode, just to give you some more background, each episode we walk you through pitch decks that GPs submitted to us and gave us their consent for us to publicly review these decks. And our sole objective here is to help you all become better investors. And by doing so, choosing the best deals to invest in. Cool. All right. So without further ado, guys, you want to add anything or should we just dive into it?
Ready to go?
Let's go. All right. So today we have a deck that was, let's see. All right. We have it up. You guys can see my screen, right? This is from Web City Properties, and it is a unique type of deal that we have not went over before on the show. And it's a workforce housing fund, which basically we'll see in a second. They buy portfolios of single family homes and operate them. And so I think this will be an interesting thing to dive into just from an asset class perspective. Before diving in, is there anything in the background you guys want to mention about this, or should we just dive into the next few slides?
Yeah, let's just dive in.
Let's do it. Disclaimers, table of contents, the executive summary. Mike, anything you want to sort of kick us off on this slide?
Yeah. So on this slide, this is a nice overview of what they're doing, what their history is, and all that. So it started in 2005. They've done 700 of these. So you got 19 years experience, and they currently have 500 units under management. So that's everything sounds good on this page. They're also telling you some other things like what they're planning to do. So they're planning to purchase things either distressed in some way, like from a wholesaler where somebody needs to get out quickly. Could be somebody that just doesn't want to get their house ready to be really marketable, or a lot of what they're doing in the example they give us later is some sort of thing like a fire, flood, something like that. So this is an interesting model where the value add is sort of taking things and doing that kind of fix and flip type thing, but instead you're going to be renting them for, it looks like, about 5 years before they sell them. So I was pretty impressed with what they were doing on this page and like things. There's stuff coming later that negates some of this, but for this one, I thought it was a nice overview of what they're planning to do.
I do have a question here of the key facts, and maybe I'm confused, right? But they say the average home will be purchased and renovated at a cost of whatever below market. So basically, they're going to buy homes and renovate them, but then what does it mean? The fund will then purchase renovated and leased properties. Like, I don't understand.
Yeah, Litan, that's a good point. That was actually my question from glancing over this executive summary was, why is Web City, their, I guess, operating company, buying and renovating and then selling to the fund? So that immediately raises, a question for me is the fund just buying the homes at a marked to market value, or is the fund getting a discount? Is that 15 to 30% discount built in for the fund? Those are a bunch of questions I have there in terms of how the methodology is being done, because it doesn't appear, why not just have the fund raise the money, buy the deals, renovate the deals, and create the value within the fund? I'm not quite sure. I would definitely want to ask more questions there.
And that's something that's, like you guys have said, that's key, because it depends which way they go with it. In the examples they're giving, it makes it seem like the fund is buying them and then doing the renovations. And if so, that's your value add. If the fund is just a way for these guys to sell it afterwards and easy, then I would want nothing to do with it, because then all the value add is going to them, the sponsors, ahead of time, and you're just an easy place sell these off.
Right. Hans, anything you want to add to this slide, or I'm good to go? I
No,
want
that was my comment.
just one thing about the whole. This has an asset class. Like I before I started passive investing, I bought a few single family homes, and when you think about this, this is if you manage to buy many homes and operate them in the same area, it basically becomes sort of like a multifamily value add type play, right? Essentially, you're diversifying doors.
Well, I love single family rentals, but they're notoriously hard to manage a portfolio of these. And they are rather concentrated within the Dallas Fort Worth metro area, but to me, it's really not the same as buying a multifamily because you just do not have the same uh, uh, scalability in terms of like expenses and things like that. It's tough because they're a scattered site, so you
They're
can't
also,
get as good.
if you're doing a build to rent development, so this is 50 homes. If you were doing an infill where you were bringing in 50 brand new builds that you were designing as build to rent, then all of the dishwashers, all of the counters, all the cabinets, flooring, it's all the same. And it's just like doing a multifamily as far as having that efficiencies versus this is going to be very difficult. Every cabinet is going to be different. Every dishwasher is going to be different. And you can start to standardize it, but it's really hard to, and you can't get that efficiencies that you can get in a multifamily product or a ground up build to rent.
But Hans, back to you for a second. Question: Isn't there also a bigger upside for this? Like you can then have this portfolio, and then you can sell each unit on its own really
Maybe.
easily, right?
Yeah, you can. I mean, there's a different exit, right? You can sell the individual uh, owner occupied, but you could also do that if you did a small build to rent community as well, which I know people do. And it's not necessarily going to be better pricing. It might be, but if you sell a portfolio, to me, single family on a scale is tough to do. I've
Okay,
invested in some funds that do it, and it's just tough to do unless it's a build to rent. And build to rent is a completely different model. It's like multifamily. Build to rent even can get multifamily loans from like HUD and Fannie Mae and Freddie Mac. These guys are not going to be able to get that kind of lending.
got it. All right, cool. Let's move on then. Their opportunity, Mike.
Yeah. So on this page, we start to hear what they're doing. So they're planning to have an all-in basis of 200,000, which in a later slide, we see that the average median home or the median home price in the areas that they're in is just over 400. So that's a really inexpensive home. And that's something to think of. Is that what you want to be investing in? But the plan as they lay it out, they're planning to buy 50 homes at an average cost of 200,000 after they're all done with the construction and that kind of stuff and getting it ready. So you've got $10 million worth of homes, 70-30 split is what they're saying here. There's some stuff later that says differently, but anyhow, at this point, you're thinking, okay, they're going to raise 3 million and do 7 million of loans and then hold things. And then at this point, they're also saying they've got this option. They'll have this portfolio of 50 homes that they can sell to one buyer who wants to buy off of net operating income, like it's a commercial property, or you could split it up and start selling it individually off to owners over time.
Hans, anything you want to add to this?
No, I think this is a good slide. Actually, it gives you a good summary of at least what their goals are. There's some things that later on that may contradict it a bit, but in general, I really like this slide. It gives a good summary of the
What do
deal
you think?
options.
What do you think about the fees, though? Like the fact that they only have a disposition fee. Does that make sense, or is it like they're
It's not to me. It's not a matter of making sense. It's is if you as an investor look at this and go, okay, are they fee heavy? No, not really. 2% disposition. Okay, that's great. But what if they're selling a home at a loss? Do they still? That's one of my questions later on. Are they going to still take the 2% disposition if they're selling a particular home at a loss? So I don't really have an issue with their fees, with their structure per se. A 10 pref is not bad.
right?
Now I don't quite understand what they mean by a 10 pref with a 20% promote. And then it says, I think it's a 10 pref 80/20, and then there's
Yeah, that's what they're saying, and that's what they go to. There's a slide later. So like on this slide, it's making you think like it's a 10% pref and then an 80/20 with no fall off after
Right.
that.
And their
That's
future
not what they're
waterfalls. there are
Yeah,
future
we
growth.
see
All right,
that.
let's dive into it.
Well, the other thing with this is I would say, and again, back on the last slide, it's a very key thing. Are they selling these to the fund or not? And the reason they may not have any initial fees, acquisition fees, or anything like that is because they're making all of their money by selling it at a profit to the fund. And so in that case, that's how they're getting paid.
Let's continue then. Next slide, housing problems, sort of the background of why they're doing this. I think we can move through this, right? Unless there's something you guys want.
Yeah. We all know that there's a housing shortage.
Housing problem, specific in DFW.
Sure. Yeah, we can keep moving.
Their solution.
This one, go back. The one thing I wanted to say there, this is where we see that it was slide 8.
Right.
One before. So this is where they're saying median single family home price of 400. One that seems like a pretty round number. So I'd want to kind of justify that for these 5 areas that they tell us later that they're investing in to make sure that that's right. But that's my.
I can promise you it's not right for the areas they're investing in, because I'm very familiar with Dallas-Fort Worth market, and where they're buying homes. The median single family home price is not 400,000 there. This is talking about Dallas-Fort Worth as a whole.
Okay. So is the median in those markets where they're buying lower?
Lower, yes.
Lower. Okay, good.
And workforce housing, which is nothing wrong with that.
Right. That's better, because if you're in a kind of a B class area and you're buying houses at half of the going rate for the median, you're pretty limited in what you're buying, and that would be a concern.
Right. Okay. Moving on here, their model. So this is the strategy they mentioned before, right?
Yeah. So what is this, slide 10?
Yeah.
Their model is interesting because they're really looking for deep distress, deep value add kind of homes that need, it sounds like, a ton of repair and renovations. It sounds like to me that they are basically gutting these homes. I can't, the font's small, but I think that, that they're paying very low prices for some of these and putting a ton of rehab into these. And so, nothing wrong with that, but I would spend a lot of time, if I was going to invest in this deal, verifying that they have the infrastructure within their company to handle, multiple homes being renovated at the same time, being able to rent them out and everything else. Because, they're essentially gutting these homes completely and taking burned out homes, things like that. I don't actually love the age of the homes they're buying. They're buying very old homes. I think that 1930 to 1970, to me, that is, now I understand they're gutting them, and their argument is going to be, well, they're virtually new. Then my next question is, then buy a plot of land, do a build-to-rent community of 35 to 40 homes, have brand new homes in the same market, and from the ground up with more efficient building. So I would kind of push that on them and ask them, why are you doing it this way versus just doing a build to rent when you're spending, single family rentals typically are great, but I've seen it work more in homes that are, you buy them, you do some cosmetic rehab, maybe $20,000, $30,000 worth, but they're virtually rebuilding some of these homes, and they're buying very old homes. They're replacing all the infrastructure, plumbing, electrical, roofs, everything. Why not just build and have a brand new home that people would want to live in, that are usually have better layouts and are more efficiently built and are better for the end consumer? So I would probably, if I was going to be looking at this deal to seriously invest in, I would push back on them and use, not saying that their model won't work. I'm just saying I would push back and see what their answer is and see how they thought about this and see if you get a good logical answer of why they would go about it this way versus just doing a small build to rent community in the same markets.
Agreed. There's more risk with this because there's variability house to house, and there's an ability for them to miscalculate how expensive something's going to be. So it just put even more emphasis on needing to make sure that these guys really have it dialed in. They've done it a lot of times before, and I'd want to look at quite a few track record things that they've done.
Yep, agreed.
I mean, high level, before diving into that, and we will, they've been doing this for almost 20 years. across hundreds and hundreds of homes. So like from an experience standpoint, it sounds like they have that experience, but the model itself, from what you just mentioned, Hans, it totally makes sense. Why spend so much? Why risk so much when you can just build to rent?
And the question, Litan, is there 20 years of experience doing this type of product?
Right.
We don't know. I don't believe that they provided a deep enough track record to know that.
Okay. Yeah, their impact, positive community impact, again, some what we like to call a little fluff slides, but it's okay. Let's just move on. Where they're looking.
I do have a comment here.
Okay.
So I'm quite familiar with Dallas. I've done a ton of real estate in Dallas and Fort Worth. I've lived there for 16 years at one point. So the areas they're buying in are on the more affordable side. It'll be more workforce housing, which is great. That's what's needed. Totally understand that. Now, I hope, one thing I would be very careful with is, and they kind of gave an address of one of their example properties later on in this deck, and I looked up the address where it is. Some of these areas that are listed here, especially southern Dallas and parts of southern Fort Worth, can be quite rough, meaning it's just a tough demographic, full on, very hard to manage rentals there. So I would want to understand a lot more about what areas they won't buy in those particular submarkets, especially southern Dallas and southern Fort Worth. There are areas there that I wouldn't touch. I don't care what the price of the house is. It's just not worth the trouble. So I would probably, as a LP, want to do a lot more digging as to what their parameters are and where they will actually buy, the submarkets within the submarket, essentially.
Yeah, you can fix a house, but you can't fix the neighborhood. And so it's one of those where that's where I've seen deals go bad before, where they thought they didn't fully recognize the neighborhood and where they were. And it can only be sometimes only a few blocks away, it could be fine. But if you're on the wrong side of a certain street, it's never going to work, and you don't want to get involved. So I think that's great, Hans.
How would you as an LP ask that question, and what potential responses what's a good answer from a GP about buying in that neighborhood that they have?
Just like Hans said, what they won't do. You want to understand their philosophy, and you want to hear a detailed list of the things that they're avoiding and why, and make sure that makes sense. So just talking with them and having them walk through it. I mean, you could say something as simple as, well, we don't get involved in gang neighborhoods, but it's like, okay, well, how do you decide it's a gang neighborhood? But they should have really detailed ideas of where they will and will not go and why. And
demographic parameters too.
Mm-hmm.
Yeah.
At least minimum demographic standards, I would think.
Yeah, they gave us that $83,000 median income. Well, that's meaningless for this type.
That's Dallas Fort Worth as a whole,
right? Yeah, you want to know within 1 to 3 miles of the property,
and we've seen decks show that, right?
Right.
Yeah.
And yeah, okay. Anything else, Hans, on this slide?
No, that was it.
All right. The features of this: the working class case study, and this is like where we get into that. Right?
That's the house I looked up.
Yeah.
So.
And it was I mean, the pictures here are nice. What do you want to talk about here, Mike? Anything about this case study?
So this one, I like the case study. This was a winner, but this to me, as their only case study, blows a few holes in what they told me earlier. For one, they're not telling me anything about cash flow. And if I'm holding this house for 5 to 7 years, the cash flow is very important to me. So they're telling me what the rent is going to be, but they're not telling me where they're at that way. They had great value creation. And that's going back to the beginning, where if the fund is buying it and putting in the construction and capturing that value creation, that's a very positive. If the fund is not getting that value creation, then that you don't have that safety net between the current value and what you're buying it at. But they did, so they did 75% value, or I guess 75% loan to value when it was at 195,000. So that's about 50,000 of equity in. So that somewhat matches what they were saying to begin with. But then when they pulled everything out, leaving in 35% equity at a $255,000 home means you're leaving 90,000 in the deal. And so it's one of those that they wouldn't be able to hit 50 homes for $10 million in the fund in that type of thing. They're going to be off by a big factor. They did get their 30% growth value add in there, but to get that, they ended up being 90% over in how much equity they're leaving behind in the deal, which will drastically impact the results of the fund.
Yeah, and I do, they did a great renovation here. My question is, one, where are they in the cycle of this deal? I can't tell. Have they rented it, or is this going to rent it at $2,000 a month? They're projecting a sale for $330,000, which immediately jumped out at me because Southeast Dallas is, again, not a high-end area at all. $330,000 just on a gut feel for me, based on my knowledge of Dallas-Fort Worth, seems awfully high. I mean, they're just assuming a 5% yearly appreciation for the next 5 years. I mean, so they're just assuming the thing just goes up. And these areas of Dallas aren't the gentrifying areas of Dallas. They're not just getting more expensive because they're gentrifying. So I would want to see a lot more data to support some of their assumptions here. And where are they in this cycle here? Have they actually rented it at $2,000 a month? Who knows? I don't know. It's Southeast Dallas is not somewhere that I would think, it may support if there's multiple people there, but you typically one working person is not going to rent a home for two grand a month in Southeast Dallas.
Yeah.
Yeah. So good potential with this case study, just a lot of questions before you want to actually.
A lot of questions. Yeah. And a lot of this can be validated, but there's not enough information to make a decision.
Yeah. And I'd like to see not just this, but a lot more of these types of case studies, like this level of it, on things that have went full cycle as well.
That's right. That's right.
Yeah, like on this page, what's the clear thing that's missing here is there's no data on the cost or the time frame held. So they're giving us a sold amount, price per square foot when they sold it, but it's like, when did you buy it? How much did you put into it? How long did you hold it? Did you rent it? There's a lot of missing information.
And they might have this.
These might not be their homes. These may just be sale comps only.
Okay. Oh, you're right. Sales comps. I was incorrectly assuming these were things that they had done, but you're right. If it's just sales comps for the one before, then it's like, okay, how are you getting 330 when everything else is at like 260?
Right.
They're probably doing it at the price per square feet, right? That's probably the calculation they're talking about. But it is really weird that they've been doing this for 20 years. Show us some more data about deals that you've done. Like, that's like your biggest moat as an operator, is like your track record. And, all right, let's move on. And this is about them a bit.
Yeah. So the next slide is where we find out that the son, that the father, passed, and that in 2020 the son took over. So 15 years the father was in charge. And we don't know how involved the son was during that time frame, but what we do know is that from 2020 on, now the son is in charge of the deals. Also with this, we find out that they've had a mix of doing single family, multifamily, and development. So fairly broad. And again, they maybe have done a lot of these, but you just want to make sure that of those 700 projects, how many have been this type of thing, this deep value add, almost reconstructing of older properties.
Right. About him specifically, Hans, anything you want to talk about here?
No, not really. I mean, it's, there's some track record information here too, but, I don't even know what is 10% annual returns across portfolio. What does that even mean? I
had no idea either. It's just like, it doesn't tell me anything. It's just sort of this weird number that they just throw out there. What does it mean? And then on page 14, they were saying I should expect an 18.4 IRR, but yet there's nothing they're giving me any indication that they've ever produced something like that. So maybe they have, but nothing in this slide makes me think that they can support that. The other thing I forgot to mention on the slide before is they're talking about the social impact. And I love investing in social impact funds and that type of thing, but you need to make sure that the number one priority is making money and doing right for the investors. And then, but you can do it in an ethical way that's creating value in the neighborhood and treating people right. And there's a great way to make money doing that. So I'm all for social impact, but you just need to make sure, again, in talking with them, that that's not their primary objective, to do good with your money, but it's to, do good while making you money.
Right. All right. So, I mean, all the rest of it is the leadership team, the track record, high level. Right?
Yeah, I thought it was confusing
Mm-hmm.
on this. It's like, what are they focusing on? They're saying they've got single family, multifamily, mortgage notes. Again, they said they had 500 homes, and now on this page they say they're having 160 single family. So I'm guessing that's, the rest of them aren't. But then this is saying in North Texas, so hopefully that means the market that they're in. So it's just it was kind of confusing on the track record to me as to how experienced they are.
Yeah, a piece of advice for the sponsors here is to, this is great. They have a variety of things that they've done, which a lot of real estate sponsors have. I'm included in that group. But, show more detail, especially around the actual subject matter of this fund, about what you have done in this asset class exactly. And you can show details on the other stuff too, because it's relevant. If you're successful in one area, you're more likely to be successful in others. But I would definitely encourage the GPs to show more detail about their history in the single family rental space.
Yeah. Yeah. It's such a waste they didn't show like more data about that. Like, they have so many of them.
Yeah.
Okay. These are their assumptions. And this is where it gets a little weird. The assumptions on the operating assumptions, right? Mike, you mentioned
Yeah,
that before.
this does not look like somebody who's got a well thought out plan to me. This seems, I didn't look at this and get confidence that they've really dialed in their numbers, and they've done hundreds of these before and know exactly what they're doing. Anytime that you start using very round numbers for things, it just makes me feel like you haven't really dug in and done a deep analysis. Also, you get down to things like legal fees, $5. I'm like, I don't know. They're mixing things because they're sort of putting in like monthly numbers with one-time costs and different things in that table, and it did not give me confidence.
I will say, let's say if they have been doing this for 20 years and have 500 units, and this is what they've seen on the right as their operating costs.
That is those are monthly numbers, definitely. Right. So, I don't necessarily have a problem with their operating assumptions. I think their market and asset assumptions are interesting because they are basically doing as much rehab, and then I already highlighted this. They're doing as much rehab as they are purchasing the property for. So are they really going to be able to average this across 35 to 50 homes? That's just a ton of work, and that just goes back to my prior point. They're virtually rebuilding these homes.
Well, builder's risk insurance, 500. Do you think they're paying 500 a month? And I mean, that would stop after the construction, versus some of these other fees are ongoing. And then like the rehab utilities of 300. I don't think
the question. Are they holding these to rent later? Yeah, there's some things that
it seemed like they were mixing stuff. You're mixing kind of project level detail stuff with ongoing costs, and it's just not a clear and well displayed thing that makes me feel like I can understand exactly what their plan is and gives me confidence that they've done this a lot and know what they're doing.
That's a really good point.
Yeah, definitely, for sure. I don't disagree there.
Their capitalization assumptions as well.
Yeah, so on this page, we had been told 70-30 split before, and then the example that they gave for the case study was a 65% loan to value, and then now in here you're at a 65% loan to value. So that drastically changes things as to where it is, because the example that they gave on the case study home was $255,000. This one, the example, when you put the down payment and the loan amount together, you're at just over $235,000. So leaving 82,000 of equity in a deal versus the 50 that they said means that you're going to probably end up with 36 homes and not 50 for the fund size. And it just sort of, there's just
only comment there, Mike, is possibly those are their initial debt assumptions. I don't know whether or not when they do the refi and they pull equity out, whether or not that somehow then allows them to buy more homes. I'm not sure. There's, again, not enough detail here to figure that out.
Yeah, in the case study, they actually had to put more in because that was one of the things I thought of too. It's completely fine if you put in 80 to begin with, and then you create enough value that then you're able to do partial refi out, and you're only leaving 50 behind. But at least in the case study, they put 50 in to start, and then at least the way I ran the numbers, it looked like they had to leave 90 behind permanently. And in this case, it seems like they're talking about leaving 82 in permanently. And you're just, I don't know. It's just sort of again, it just doesn't make me feel real confident. We also now see the hurdles where, and this was confusing too. Normally you have a hurdle that's clearly, is it an IRR or is it going to be an equity multiple? And here they've mixed those. So, until you get to a 1.5 equity multiple, you're at, or 10% IRR, you're supposed to be getting 100%. But those are different because the example that they gave on the next page is a 4.1 year hold. So, that doesn't match up. If you knew it was going to be a 5-year hold, then maybe you could say, okay, they're doing an ARR. But there's just enough things here that it just seemed confusing to me. And I don't like that. It's just something that I want them to be very clear on what it is and easy to figure out. And then the step downs aren't bad. I mean, an 80-20 is nice after a 10% pref, but you're stepping down pretty quickly on what is almost like a development deal to a 70-30 and a 60-40.
One thing that I would, as an LP, want to understand is, one, I mentioned this earlier, he's taking a disposition fee on all sales, which is fine. But if for some reason the deal doesn't go well and they're selling the home at a loss or a very low gain, are they still going to take the fee no matter what? That if they're selling at a loss, that means it's coming out of your equity as an LP. And even bigger, kind of a bigger question I have is, the hurdles are all well and good. It is confusing, as Mike said, about the equity multiple versus an IRR hurdle. It's kind of one or the other. I don't know how you can't really do both unless you do the greater of or something. And they don't make
and maybe that's what it is. If it's the greater of, fine.
Yeah. So, but my bigger question really is around how do you handle hurdles if you're selling home? You say you have 35 homes in the fund and you're selling the homes one at a time. Are you doing the hurdle calcs based on each home's economics, or are you doing the hurdle calcs based on the fund economics? Huge question. Yep. And it really affects the payout to the LPs. And I have a feeling, based on the look and feel of this presentation, that the GP may not have thought through this completely. I don't know. I'm just assuming. But I would definitely dive into that deeply as an LP to really understand how the waterfall works on a per house basis or overall as a portfolio basis.
Agreed. The other thing that they haven't talked about yet that I think has to be in there is there's no property management fees discussed. And they talked earlier on how they were vertically integrated. There's 10 people in this group. They're making it seem as though they're doing in-house property management, but yet there's no talk of any cost to that.
Well, they do have that, Mike, in the operating assumptions. They have a 5% property management fee.
Was it? Okay, I missed that. Yeah. Then where was that at?
Over here.
Yeah. It's 5%, which is actually quite low for single family.
Oh, right. Okay, great. Yeah, good. I'm glad they addressed it. The only other thing is that a lot of times there's a construction fee or a construction management fee. It doesn't seem like they have that. Again, it's great if they don't, but it goes back to that initial slide question of, are they making money before they sell this to the fund, or are they, making the money for the fund?
I have a question as well, because Mike, at the beginning, you mentioned the loan to value, and at the case study, they showed at the beginning 75% loan to cost, and then they refied into a 65% loan to value.
Right.
So they took a hard money loan. What they're doing is they're just taking a hard money loan and then increasing the value through the renovations and then getting a 65% loan to new value. And they're able to pull out the 75 and maybe even get some cash back.
Right. But when they mentioned at the beginning that their objective is 70% loan to value, doesn't that average out basically like the 65 and the 75%?
No, because you're
I don't
worried
think you can do that.
long term.
Yeah.
The construction loan, the hard money loan should be 6 months, 9 months, 12 months, something in that range, versus this is the 5 to 7 year. They're actually, it looked like they were putting in 30-year debt on these, is at least what they had in there on the term of 360. That slide we were just on in that upper box there. So they're putting on the permanent debt. So that's the part that I worry about. I really am not as worried about how much money has to go in to begin with. It's how much do you have to leave in it, because that determines how many total properties you can put into the fund and how much you're going to be making money off of.
Got it. All right. This is really interesting stuff and super helpful. And I hope everyone who's listening, this is like really good questions to ask, and for managers also to perfect the details you present here. Now, how about the projected returns?
They're fine. I mean, it's pretty good. I think one thing that jumped out to me here is I would have expected the stabilized cash on cash to be a little bit higher for this demographic and this level of a home. Typically, when you're buying this level of a home, you're going to have a higher cash on cash. The yield on cost, which is essentially your cap rate, also, especially for 2025, seems at 6.35% seems awfully low to me. To have a yield on cost of that low on homes in this kind of rougher areas, you would expect a higher yield on cost to me. Again, not enough detail here to really understand it and to know why their yield on cost is there. Maybe it's because maybe they're putting too much rehab in these homes, or they're assuming a higher cost of these homes, and then the rent will support. You got to be careful there. I just would assume the yield on cost would have been a little bit higher. Meaning yield on cost is the stabilized cap rate, essentially.
Right. And I do have a question on the refi, because if they do plan on refinancing these properties after renovation, does the capital come back to the LPs or does it stay in the fund?
Well, yeah, that's one of the questions. Is there an investment period? Then are they going to recycle the funds? You're right. Is there even any cash out? They may be doing it at 75 to 80% hard money and then refining at 65, meaning they just basically are taking out the debt on these. But that's something I hope Litan would be provided in the company agreement, because it's a capital transaction. You see it in the company agreement or even in the PPM. That's the kind of detail, you're right, that should be shown. And what happens on a refi.
But essentially, in this deck, we have no assumption that they will be returning capital to investors until
it looks like only upon sale.
Right.
Yeah, you're only getting the cash flows. So nothing the first year. And then it looks to me like when you go to the annual return on invested cash, you got nothing in the first year, nothing in the second year, and then you're at the 4%. I didn't come up with on the left box, they talk about 6.9% stabilized cash on cash, but at least the return on invested cash didn't seem to kind of match up to that, to know really where they're coming to. And then the cash on cash below didn't really match either. I don't know if that's an average of those 3 years that it's paying or what they're coming up with that way. And then also, they're saying a 5 to 7 year hold time, but at least the way I did the math in the left box, where if you take the average annual return and divide that by the equity multiple divided by the average annual return, I got like a 4.1 year hold. So it's just more, you want to understand how they're coming up with these numbers and get a better feel for it to make sure that you know what you're getting into.
Right. Hans, anything you want to add to this?
No.
So, the life cycle, the fund.
It's pretty simple stuff. Yeah. It's normal.
All right. Overall, like closing remarks.
Page 26, the one comment I had there is they said that they're calling capital, which that's one of the things I'd want to know is how often, are they calling my capital for each of the 50 homes that they buy? Are they doing it monthly, quarterly? what kind of time frame. It looked like that they were talking about maybe a year and a half that they're calling.
2 years. It'll be over 2 years, Mike. 2024 and 2025. You go to slide 24. You can see the LP contributions over 2 years. So,
right.
My guess would be they're going to call that on I would think, a quarterly basis. It
Hopefully.
can't be on a per house basis. So.
I mean, that's, again, you want to know, because capital calls aren't fun just because, it's a hassle, you have to meet it, that kind of thing. But quarterly is reasonable, and where you're sending them a quarterly, wire and that kind of thing. But if it starts being any more than that, it starts to become,
And to be clear, for a lot of newbies listening, this isn't a capital call, meaning the deal isn't doing well, they're having to call more capital. This is a fund whereby they're not buying all the assets up front. So they'll call part of your cap. You commit $100,000. You might send them 25 today, 25 next quarter, 25 the quarter after that. And so they'll call it over time such that you don't have to contribute your full 100K commitment day one. And that's very common for funds like this.
Yeah.
Yeah.
And then
I just want to say one thing on the capital call part of it. And I think it's an important point you guys just raised on that. But there's like this always conflict where the GP is incentivized to call on capital, and then they're pressured to find deals. And that's risky, because then they're incentivized to find these closed deals because LPs want to deploy capital. And that might lead to a situation, not necessarily these guys, but overall, where they do subpar deals because they need to call on capital. And so, personally, I'm fine if they don't even call it capital because they didn't find a good deal.
That's right.
Agreed.
So yeah, sorry, go ahead.
Well, the other thing I wanted to show here, so this is an FAQ, which is nice. But one of the things I would point out is the second to the bottom question: when should I expect my first distribution, and how often will you send distributions? They don't even answer it. They said all distributions will be sent on a quarterly basis. So it's like they came up with the question for me, and they didn't ask or answer when my first distribution is going to be. And those are the kind of things that it's like there's not that attention to detail that I want to see in a deck. And maybe that's fine, they just missed it, but it's just little things like that tip off to me that they're not, paying attention to all of it.
Right. That's a good point. All right. Anything else, guys, you want to add to this?
I think I'm good.
I mean, I like the asset. I think it's an interesting asset class. I do think, we don't see enough of these. It's interesting, specifically a lot of questions to be asked here. And a lot of remarks that we talked about.
Well, I would say I've seen people do this in other markets, and there's a lot of value can be created and a lot of good by coming in and, being somebody that you're cleaning up the houses that need to be cleaned up. You're kind of making the area better, and you're creating value in it. And so if they know what they're doing and they can pull it off, you can do that thing where, you're doing a social good and you're making a decent amount of money for the investors.
Wraps up another great episode of Pitch Deck Insights. A huge thanks to you guys, Mike and Hans, for your expert insights. Stay tuned for our next episode. And don't forget to subscribe, share your thoughts, and check out Visor for tracking and managing your private investments. Thanks for joining us. And until next time, keep investing wisely.